So what happened last week? A lot of people will talk about the unwind of the Japanese yen carry trade. It's questionable whether there was really an unwind. We'll get into that a little bit later, but Japanese stocks certainly were down even more than U.S. stocks were down on Monday. But on Monday, we had a significant down day, and all week our Crescat's short strategies, our long short and global macro fund have been benefiting from the short positions in those strategies. We think there's a lot more to come. The news of Warren Buffett selling almost half of his Apple holdings, Apple computer holdings, which came out on Saturday last weekend, I think was a big catalyst for the market sell-off on Monday. Even more so than the yen carry trade unwind. So look, here is a technical chart from John Hussman. A lot of people, look at John Hussman's research, call him a perma bear. He's a Stanford PhD, really smart guy, a money manager. He uses valuation criteria to highlight when it's highly risky to be owning stocks. But when he comes up with technical indicators that also confirm his valuation hypothesis, it gets really interesting. This is a technical setup that Hussman just put out today because we had that big 2% up day in the S&P. What was it, yesterday or the day before? And so that was a new kind of criteria to add to the picture here. So when the S&P is up more than 2% daily, when you have new 52-week, the number of 52-week lows exceeding the number of 52-week highs, when you have fewer than 60% of individual stocks above their respective 200-day moving average and averages, and when you have at least two Hindenburg omen signals in the past 10 weeks. Hindenburg omen signal is when you have both a large number of new highs and new 52-week highs and new 52-week lows at the same time. It's a measure of divergence. It also has some breadth. You also have to be in an uptrend, and you have to have a market breadth deterioration with the McClellan oscillator, yada yada. But look at. We have this valuation top at the same time as we have this incredible confluence of technical signals. These red lines in this chart are all the other times when you had this same confluence of technical indicators. And here we are today. Let's go on to the next. This is showing Hussman's main valuation level criteria. And he put this one out on Monday after Monday morning after we'd already had a big downward move in the S&P 500. And you can see that even after that first little leg down, we are still near a top in this GVA to market cap, to this market cap to GVA measure, basically, that is a fundamental valuation measure. It's kind of like a Warren Buffett market cap to GDP type indicator, but showing that the overall S&P 500 is basically at the highest valuations it's been since that 2021 top, and before that since 1929, even higher than the tech bubble top in 2000. So the point being, we're still at the top here. We haven't seen anything yet when it comes to this market correction that we're expecting. At the same time, we have all these advanced recession leading indicator kind of signals coming up. And of course, if we get a market meltdown, that will be one of the factors leading us into a recession. But let's go on to the next. So this was the VIX, the volatility index, on Monday, which spiked to a high that was reminiscent of the COVID early 2020 market VIX spike. And but there's some disagreement out there among technicians and market watchers and strategists, et cetera, as to whether volatility really spiked as much as it did. If you look at the volatility index on the futures, the Cboe VIX futures, as opposed to just the VIX index, you can see the VIX futures were open a much longer, more continuous period, so there you can see there was a lower spike than the VIX index, and basically there was some orders, someone putting on put options, put option exposure long right at the market open, which caused that Cboe VIX index to have an unusual spike at the open, but I think it overstated the vol spike. Vol has since pulled back substantially over the course of the whole week. I think it's a setup for a much bigger and more prolonged spike in vol, like we've seen in other bear markets and recessions. I don't think this is a one-day Volmageddon type of a spike. I think it's something that is only the beginning, like those valuation charts that we were just looking at showed. So let's go on to the next. Again, a fundamental chart here looking at profit margin. When profit margins peak, you're at the peak of a cycle. It's just another indication fundamentally of how much downside there is in fundamentals if we go into a real recession, a real market downturn. When you start with peak margins and peak profits at the top of a business cycle, you shouldn't be stacking on a record market multiple on top of that. You should be stacking a low multiple on top of it, because you need to be looking forward to the business cycle and just more evidence, and especially when you look at the 5 of the Magnificent Seven. When you add those, this is looking at it, with and without mega cap tech. What is it here? It's mega cap tech X NVIDIA and mega cap tech. So it's basically looking at mega cap tech margins, and it's showing that they're at record high margins. This is a large cap, mega cap tech dominated market. We've shown 100 different ways as to why this is the signal for the market top, this unsustainability and this AI euphoria of the fundamentals for the mega caps. This is just another way of looking at it and showing how we're at peak margins for these companies cyclically. Let's go on to the next. Record stock ownership among households. Again, part of the setup for why this is likely to be an historic type of a market top. Household positioning in stocks is offsides. It is at a record percentage of total financial assets is allocated to stocks right now among U.S. households, and it's the same as where we were at that shorter term market peak back at the end of 2021, and it's the highest it's been in the history of this data essentially. So let's keep going. So there was a lot of talk about the unwind of the yen carry trade because, over the weekend and on Monday morning, Japanese stocks were down even more than U.S. stocks. And so all the talk was about the unwind of the yen carry trade. The Bank of Japan gave a surprise, rate hike, and that, had been causing the yen to strengthen. But it wasn't until early Monday morning that Japanese stocks collapsed. And this was just an interesting post on Twitter with all of the news media and market pundits talking about the unwind of the yen carry trade rather than the unwind of Warren Buffett's Apple stock. This guy said, JP Morgan and Goldman Sachs are both saying that the unwind of the yen carry trade is basically already fully played out. And this guy, Nobody Special at JG_Nuke on Twitter said, how does the yen carry trade, or how does the yen weaken as the carry trade unwinds? I mean, look, if the yen carry trade was really unwinding, the yen would be strengthening like crazy, and it just shows that during the period of the collapse, the yen actually appreciated. So let's go on to the next. And the point of that is the BOJ has still got the biggest balance sheet relative to GDP of any central bank on the planet, and there's a lot more potential issues to play out in Japan, and to play out with the dollar versus the Japanese yen, and Tavi may have some more comments on that. But here's another chart showing showing the, basically the prime rate is from B of A, and showing how small businesses, their funding is basically tied to the prime rate, and we're at the highest prime rate since September 2007, basically at the peak of the housing bubble. And this is affecting small businesses. Why does that matter? Let's look at the next chart. It matters, and this is something that a point that Tavi has been making for a while, is that when it comes to the employment data and the likelihood for further weakening in the employment data, it matters because small businesses are the biggest jobs creators, in the country, and now you can see here, small business loan availability indicator in dark blue, how that has already been trending down. Small businesses are having trouble accessing credit. Do you think this is going to affect employment? Look at how historically it normally correlates really well. Right now, we think it's a leading indicator, for initial jobless claims. And we had this kind of surprise, or 1 week of better than expected initial jobless claims on, what was that, Tuesday, and the market rallies on that. I mean, come on, look at a 4-week moving average of initial jobless claims, this is something that we're still in the early innings of the employment data, weakening here, and we can't, we don't want to rely on one better than expected weekly jobless claims data to say we're out of the woods on an impending recession. No way. But I think that's a couple more for me, and I'll wrap up. Commodities. This chart was going around on Bloomberg, and just showing positioning how hedge funds. This is a contrary indicator. When hedge funds are ultra bearish in their positioning on commodities, this looking at a basket of 20 commodities, it's normally a bullish signal, just like it was in early 2016, just like it was in 2019, going into 2020. It didn't unfold till later in 2020 after the COVID recession, but it unfolded in a big way. So we still believe we're in a great rotation kind of market, meaning the rotation out of overvalued long duration financial assets. That means things like mega cap tech growth stocks, as well as fixed income securities and long duration treasuries, and a rotation into undervalued commodities in a stagflationary type of a recession still to play out. All this fear of another 2008 kind of a deflationary recession is reflected in this positioning right here, and in commodities in general, which are still ultra depressed relative to the S&P 500. And we like commodities. Let's go on to the next. We especially like gold. Snowline Gold is our largest public equity position across the whole firm, and it's been pulling back recently because of this Yukon mining incident at Victoria, their Eagle mine, which is unrelated to Snowline, except it happens to be in the same in the same province in Canada. And so everything Yukon related got sold off. We think it's an overreaction. Mining in the Yukon is not going to stop. Snowline just a few days ago did an island reversal, double bottom. Island reversal meaning that one day it was down a few days ago near 4, touched into the 3s. When Snowline put out their results, which I'm sure Quentin is going to talk about yesterday, it popped back up substantially. I think we have an island reversal. That's when you have a stranded price there. It looks like it's stranded on an island. Very bullish technical signal. I think I think that's a double bottom on the bottom of that channel. I think it's going to be breaking out above that $6 Canadian per share level that you see at the top of the channel. I think the next step is breakout above there. Michael Gray at Agentis just put out a new research report reiterating his $23 price target. We think that's conservative. Anyway, I'm sure Quentin will be talking more about Snowline. Hopefully the worst is over there. It looks like a great opportunity here.